Welcome back to Talk Tickers. This is the deep dive where we strip away the corporate gloss, ignore the PR spin, and get right down to the raw numbers and the strategic signals that actually move markets.
We're here for the institutional mindset. The analyst, the portfolio manager, anyone who really wants to understand the signal, not get drowned out by all the noise.
And there's a lot of noise to cut through today.
That is an understatement. We read the transcripts, we crunch the filings, we track the institutional flows so you don't have to. And after the last 24 hours, yeah, there's a lot to get through.
Today is Wednesday, February 18th, 2026.
Okay.
And if you've been watching the screens at all this morning, you know exactly why we're here. We're doing a deep dive into Leidos Holdings, ticker LDS.
They dropped their Q4 fiscal year 2025 results and, crucially, their outlook for fiscal year 26 just yesterday morning.
And looking at the tape, well, it looks like we have a bit of a crime scene to investigate.
It's a fantastic setup, really. You could call this a Tale of Two Cities quarter, and it wouldn't be an exaggeration. Well, on one hand, you listen to the management team on the call, CEO Tom Bell, and they are practically popping the champagne. They're talking about an outstanding year. They're pointing to record cash flow, significant margin expansion.
The highlight reel.
The highlight reel. The strategy is firing on all cylinders. I mean, they sound like a company that just won the Super Bowl.
But the market clearly disagreed. It hated it.
Hated it is the right word. The stock just plummeted. It fell about 8.4% almost immediately after the print.
We're talking from around $176 a share all the way down to the low 160s. That's a significant haircut.
And the volume, you have to look at the volume. It was over 2.4 times the 3-month average. That is not retail traders getting spooked. That is a high-conviction institutional sell-off. That's
capitulation. That's people running for the exits and not looking back.
It is. So the core tension we need to resolve for you today, the central question is this. Leidos is printing cash. I mean, it's a cash machine. They're beating their EPS estimates.
Right.
But their top-line revenue growth has completely stalled. And the guidance for the start of 2026 looks, let's call it soft.
So our mission today is pretty clear. We're going to unpack this revenue miss. Yeah. We have to figure out why the market is punishing a company that just delivered 127% cash conversion.
Which is an incredible number.
Incredible. And we're going to look at this massive CapEx bet they're making. I mean, they are literally tripling their capital expenditures. And of course, we have to talk about the elephant in the room. The $2.4 billion acquisition of Entrust, which signals a huge pivot toward energy infrastructure.
It's the cash machine versus the growth mirage debate. Is this a value trap that just prints cash while it slowly shrinks? Or is it a coiled spring, investing heavily for a massive breakout in the future?
That's the billion-dollar question. Let's get into the numbers. We have to start with the headline figures, the beat versus the miss.
Right. So let's start with GAAP EPS. Came in at $2.53. That's up a very strong 19% year over year.
19%. And that's GAAP. So that includes all the messy one-time stuff. To see double-digit growth there shows the core engine is working, at least on the profitability side.
Absolutely. Then you move to the non-GAAP, or the adjusted number, which is what the street really focuses on. They hit $2.76 per share.
And the consensus estimate on the street was sitting at, what, $2.61?
Exactly, $2.61. So that's a solid beat. They came in 15 cents ahead of expectations. In a vacuum, on any normal day, you'd expect the stock to pop on a beat like that. Profitability is clearly improving. They're doing more with less.
In a vacuum, yes. But we don't trade in a vacuum. We trade in a market that is right now completely obsessed with top-line velocity, with growth.
And that's where the entire narrative just broke down. Revenue. It came in at $4.207 billion.
The consensus was looking for $4.31 billion. So that's a miss of over $100 million.
A significant miss. And maybe more concerningly, it actually represents a 4% decline year over year.
And that's the killer. In this market environment, especially for a name in the defense tech space, revenue stagnation is treated like a disease. Investors are paying a huge premium for growth. When you print a negative sign in front of your revenue percentage,
the algorithms just start selling. They don't wait. A human doesn't even have to read the press release. The machine sees negative year-over-year revenue. It's just sell.
It's the kiss of death for any momentum strategy.
Yeah.
But okay, this is where it gets nuanced, and this is where the bull case really tries to make it stand. We need to talk about the quality of those earnings.
We do, because the efficiency metrics here were, frankly, incredible.
Let's start with the margins. The adjusted EBITDA margin hit 13.2% for the quarter.
Which is an expansion of 160 basis points year over year. That is a significant jump in efficiency. It's not a small tweak.
So what does that mean in plain English? For every dollar of revenue they bring in, they're keeping a lot more of it as profit. They're running a leaner ship.
A much leaner ship.
Yeah.
And then there's the cash flow. That was the number that really jumped off the page at me. Free cash flow for the quarter was $452 million.
A huge number. But the metric you pointed out before we started was the conversion rate. A massive 127%.
127%.
Okay, let's pause on conversion rate for a second.
Yeah.
For the listener who doesn't live and breathe this stuff in the CFO's office, break that down. Why does that number matter more than just the raw cash total?
Sure. So cash conversion is a simple ratio. It compares your free cash flow to your net income. Now, if you have a conversion rate over 100%, it means your accounting earnings, your net income, is actually understating the amount of cold, hard cash that's hitting the company's bank account.
So it suggests high-quality earnings.
Very high-quality earnings. It means they aren't just booking paper profits that they might never collect. They are collecting cash. It usually points to really strong working capital management. They're collecting their bills from customers faster than they're paying their own suppliers. It tells you the underlying business is incredibly liquid and healthy, regardless of what the accounting accruals might say.
So the bull case analysis here is that the company is leaner, it's more profitable per dollar earned, but they are earning fewer dollars than the street wanted.
Precisely. And that brings us directly to the bear case and the reason that stock cratered 8.4%. Investors, or at least the algorithms that trade for them, looked right past the earnings beat. They ignored the incredible cash flow, and they fixated on that revenue contraction.
They saw a company that's shrinking, not growing.
Exactly. And when you combine that with the guidance for 2026, which we'll get into, which is very backloaded, it just creates a ton of anxiety. The fear is that the company is shrinking its way to profitability, which, it works for a while.
Until you run out of costs to cut.
Until you run out of costs to cut. You can't shrink your way to greatness forever.
All right, let's dig into that revenue number specifically, because management had a lot to say about why that number was negative. They basically called it noise. Were they just making excuses, or is there some legitimate distortion in these numbers?
Look, they cited two main distortion factors, and we have to give them a fair hearing. First, the calendar.
The calendar.
Yes. The fourth quarter of fiscal year 2024 had an extra week. It was a 53-week fiscal year for them. So the year-over-year comparisons are naturally going to look bad because you're comparing a standard 13-week quarter to a 14-week quarter from the prior year.
So that's just math. It's not a fundamental business problem. You can't fault them for the Gregorian calendar.
You can't. That's a technical foul, not a strategic one. So that's point one. Point two, they cited the government shutdown. There was a 6-week continuing resolution and shutdown impact in FY25 that delayed awards and slowed down billing.
Okay, this is a classic Beltway problem.
Yeah.
Every government contractor has to deal with this. So why is it a bigger deal for Leidos?
Well, it tends to hit services companies harder than hardware companies. Think about it. If you're Northrop Grumman and you're building a B-21 bomber, you can keep welding the metal, even if the contract paperwork from the DoD is delayed by a few weeks. You know the order is there.
The work can continue.
The work continues. But if you're a services company like Leidos, in many of your segments, you are selling hours. You're selling the time of your engineers and consultants. If the government office you're supposed to be working in is closed or the funding for your project is frozen, you cannot bill those hours. That revenue evaporates. It doesn't just get pushed to the next quarter. Sometimes those hours are just gone forever.
So if we play the what if game, what management on the call called their normalized view, what does the revenue picture look like?
Great. So management claims that if you strip out the extra week from last year and you try to account for the shutdown impact this year, revenue would have actually been up about 4%.
From down 4% to up 4%. That is a huge swing. So is the market wrong? Is this just an accounting optical illusion that created a massive selling opportunity?
I think it's a bit of both. The 53rd week is a completely valid point. No one can argue with that. But the shutdown impact, well, every defense contractor deals with government inefficiency. Yeah. It's part of the cost of doing business. The fact that it hit Leidos this hard suggests some potential vulnerability in their contract mix.
And even so, a normalized 4% growth. Mm-hmm. That's not exactly lighting the world on fire.
It's not. Not when you have other defense tech peers growing at double-digit rates. Yeah. 4% is basically just tracking inflation. It's treading water. It's not the kind of growth that commands a high valuation multiple.
Okay, so let's break it down by segment. We need to see where the bleeding is actually happening, because it wasn't bad across the board.
No, it wasn't. The commercial and international segment was actually a real bright spot. It was totally unaffected by the U.S. government shutdown, obviously. They saw a very strong performance in the U.K. and in their commercial utilities business.
So the diversification strategy is working.
It's working. That part of the portfolio is acting as a good hedge. And then you have defense.
In defense.
Defense was robust. They're seeing really good traction in things like hypersonics and force protection. This is the kinetic side of the business, the missiles, the shields, the hardware. That part of the house is very healthy because, unfortunately, the world is a dangerous place right now, and demand for those kinds of solutions is pretty inelastic.
So that leaves us with one area. Where's the anchor dragging this ship down?
It's the health and civil segment. This is the problem child right now. Revenue is down even on an adjusted, normalized basis. And there are two big reasons for this.
What are they?
One is a massive program they call DIMSUM. It's an acronym, DHMSM.
Dim sum. Sounds delicious, but I'm guessing it's not food.
No, it stands for the deployment of the Federal Electronic Health Record Modernization. It's a huge multi-year contract to modernize all the health records for the military. The issue is that program is transitioning.
Transitioning from what to what?
They're moving from the deployment phase, which is high activity, high revenue work, to the sustainment phase.
Help us understand that transition better. What's the real world analogy?
Think about building a brand new house versus just maintaining it. When you're building it, that's deployment. You have construction crews everywhere. You're buying tons of materials. There's massive activity happening every single day. That's very high revenue.
Yeah.
But once the house is built, you move into sustainment. You just need a plumber or an electrician to come by once in a while to fix a leak or a faulty switch. Sustainment is usually very high margin, profitable work, but it's much lower revenue. The big surge of work is over. And for Leidos, they're simply running out of military hospitals to deploy this new system to.
So that's a natural life cycle decline of a major program. It was expected. What's the other headwind in health?
The other headwind is managed health services, specifically the VA medical exams. This has been a massive cash cow for Leidos for years, but the landscape is shifting, and it's not shifting in their favor.
Let's zoom in on this health segment then, because this seems to be the source of a lot of the market's anxiety and the fears about margin compression.
It is. So for years, Leidos has been dominant in the business of doing medical disability exams for the VA. When a veteran submits a claim and needs a disability rating, Leidos is one of the companies that manages the network of doctors and schedules the exam. It's high volume, steady, decent margin work.
But something changed.
Something changed. A fourth vendor has now entered the space.
Competition. The invisible hand of the market comes for the excess margins.
It always does. The VA decided to bring in another player to spread the work around and presumably drive prices down. So management on the call explicitly guided for lower volumes and lower margins in the health segment for FY26 because of this.
So they're losing market share, not because they're performing poorly, but simply because the pie is now being sliced into 4 pieces instead of 3.
That's a perfect way to put it. Their slice of the pie just got smaller by default. And on top of that, there's a major recompete of the entire contract coming up, right?
Yes, I saw that. The RFP, the request for proposal, is expected in mid-2026. And in the world of government contracting, the word recompete is almost always a code word for you're going to have to lower your prices.
We call it sharpening the pencil. When you have to bid to keep the work you already have, especially now with new, hungry competitors in the field, you almost always have to offer a discount to secure the win.
What's management saying about that? Are they confident they can hold the line on price?
They're projecting confidence. They claim they can sustain 20+% margins in this segment long term, but that's a long-term view. The immediate 2026 outlook they gave is for modest declines. And the market, being the market, is pricing in the risk that they either lose a significant chunk of this business or have to slash prices to keep it, which would crush margins.
So to summarize the entire health situation,
yeah,
you have a major IT program, DIMSUM, that's naturally winding down its high revenue phase. At the same time, your other cash cow, the VA exams, is getting attacked by new competitors.
It's a perfect storm. It creates a classic air pocket in their growth story. They need to find new, large programs to fill that revenue hole, but that takes time. Contract awards don't happen overnight.
Speaking of finding new work, this brings us perfectly to the biggest strategic move of the quarter, the pivot. Leidos is making a huge bet, acquiring a company called Entrust Solutions Group.
This is a massive deal, a $2.4 billion acquisition, and it's all cash.
$2.4 billion. That is a lot of dry powder to deploy in one shot.
It is. They're funding it with a combination of cash they have on hand, commercial paper, and some new debt. It's going to spike their gross leverage up to 2.6 times EBITDA.
Is that a dangerous level?
It's not in the red zone. Their internal ceiling is 3.0x, so they're staying below their own comfort level. But they are definitely levering up the balance sheet. They are consciously deciding to use debt to buy growth.
And what are they buying for that $2.4 billion? What does Entrust actually do?
Entrust is an engineering firm, and they are squarely focused on the utility sector. This is Leidos making a massive bet on a theme they call grid modernization.
Okay, let's unpack grid modernization. Because on the surface, that sounds like fixing power lines. Why does a high-tech defense contractor want to get into the business of fixing power lines? Is this just a random diversification move?
No, it's actually incredibly strategic if you connect the dots. It's all about where the future demand for engineering services is coming from. And management, on the call, linked this directly to two things: data center load growth and the AI revolution.
Ah, there it is, the AI angle. Every company needs an AI angle these days.
They do, but this one is very real and very physical. Think about what's happening. You have these massive hyperscale data centers being built by the tech giants to train these large language models. They consume absolutely staggering amounts of power, gigawatts of power.
More than some small cities.
Exactly. And the current U.S. power grid, it just can't handle it. It's old, it's fragile, and it was never, ever designed for this kind of concentrated load growth. And that's before you even factor in things like vehicle electrification and what they call extreme weather hardening, preparing the grid for more intense hurricanes, wildfires, and storms.
So Leidos is effectively saying, we're not just going to be a defense IT company anymore. We're going to be a power engineering company.
That's the pivot. They want to move from just securing the software that runs on the grid to actually engineering the physical infrastructure that powers the whole system. They want to be the ones designing the new substations and the high voltage transmission lines that are required to keep the lights on for the AI revolution.
It's a classic picks and shovels play on AI. But instead of selling chips, they're selling the grid engineering.
It's the plumbing. They're selling the plumbing for the digital economy.
Okay, that sounds like a very smart, long-term strategic play. But what is the financial impact right now? If it's such a great idea, why didn't the market cheer this announcement?
That's the catch. And it's a big one. The deal is EPS accretive, but not until 2027.
2027.
Yes. The deal is expected to close at the end of the second quarter of 2026. So for this entire upcoming fiscal year, it's mostly going to be costs. You have integration costs, financing costs from the new debt, all the transaction fees. It doesn't start really adding to the bottom line in a meaningful way until the following year.
This just reinforces the narrative that 2026 is a transition year, and investors, especially in this market, they hate transition years. They want growth years.
You're asking investors to be patient. You're asking them to hold the stock through a year of messy integration and debt paydown, with only the promise of a payoff in 2027. In a market that is addicted to immediate gratification, that is a very, very tough sell.
Let's talk about the other huge bet they're making, because it's related. We talked about the $2.4 billion they're spending on Entrust.
Yeah.
But they are also tripling their own internal capital expenditure, their CapEx, in 2026. They're going from a run rate of around $120 million to $350 million.
This is a huge signal. Usually, Leidos is what we'd call an asset-light business. They sell people, they sell services, they write code. You don't need a lot of heavy machinery for that.
Right.
But this $350 million in spending is not for new office chairs and laptops. This is for manufacturing capacity.
So they are getting into the business of bending metal.
They are bending metal, they're building factories, and they were specific on the call about what programs are driving this investment. First, a program called IFPC, the Enduring Shield. This is a cruise missile defense system.
Okay.
Second, hypersonics. They dropped a few program names like Mayhem and Dark Eagle.
Dark Eagle. That sounds like something out of a movie.
It's a land-based hypersonic weapon system, very fast, very difficult to defend against, and a very, very high priority for the Pentagon. And third, they mentioned maritime, specifically unmanned surface vessels.
The drone ships.
Drone ships. And we need to talk about the co-investment narrative they use, because this is a fascinating shift in the entire defense industry.
Okay, what is this co-investment idea? Management used that phrase a lot on the call.
They did. Management started that they are negotiating framework agreements with the Department of War, the DoD, to co-invest in this new manufacturing capacity.
Translate that for us. What does that actually mean for the shareholder? Why should they care?
It means the government is coming to contractors like Leidos and saying, look, we need you to build the factories and the production lines before we give you the massive multi-year production orders. The DoD doesn't want to wait 3 years for a factory to be built after a major conflict starts. They want the industrial base to be ready to go on day one.
So Leidos is saying, okay, we will put up our own cash, our shareholders' cash, to build these facilities on the promise that you'll give us the big contracts later.
That's the deal. And it sounds risky, right? What if you build the factory and then the order doesn't come through or Congress cuts the budget?
Exactly my question.
Yeah.
That's a huge risk.
It is a risk, but it's also a massive barrier to entry. If Leidos spends $350 million building a state-of-the-art hypersonic factory, it becomes very, very difficult for a competitor to come in and steal that work later on. It essentially locks them in as a strategic partner with the Pentagon. It transforms them from being a commodity service provider to an essential piece of the national security industrial base. It's a moat, a very expensive moat.
But in the short term, in 2026, high CapEx crushes your free cash flow.
That's the trade-off. Free cash flow is guided down slightly in 2026, specifically because of the spending surge. So again, it's the same story as the acquisition. It's pain today for gain tomorrow, specifically in 2027 and beyond, when those factories are up and running and churning out hardware.
I want to circle back to the maritime thing. Drone ships. Why is this suddenly such a big growth pillar that it requires this kind of investment?
Because the U.S. Navy has a massive structural problem. They cannot recruit enough sailors. They have huge recruitment shortfall, and it's getting worse every year.
Right, the demographics are working against them.
Completely.
Yeah.
But at the same time, they need more ships, a larger fleet, to counter growing threats in the Indo-Pacific and elsewhere. So what's the only possible solution? You need ships that don't require sailors. Unmanned surface vessels.
The robot navy.
The robot navy. And Leidos is positioning itself to be the brains of that fleet. They're not building the ship hulls, but they're building the autonomy software, the command and control systems, the hardware integration to make these drone ships work as a cohesive fighting force. It's a huge potential market, but it's still in the early innings. The investment is speculative, but the demographic trends regarding sailor recruitment make it a necessary bet.
Let's move on to the internal changes. They announced a reorganization as part of their North Star 2030 strategy.
That's right. They're shuffling the deck internally, moving from 5 different sectors down to 4 new reporting segments.
So what are the new buckets they're putting the businesses in?
First, you have national security and digital. This is the behemoth. It's the new core of the company. It holds all their cyber work, their intelligence community work, the big IT modernization contracts. This is the traditional legacy Leidos business.
Okay, that makes sense.
Then you have a new segment called Homeland. This one's interesting. They're combining their commercial work, their international business, and their homeland security portfolio things like the airport scanners and border security tech. It's basically a protection and screening segment.
And then health gets broken out as a standalone segment.
It does, which makes perfect sense given the challenges we just discussed. They need a focused leadership team whose only job is to fix the margin issues and win that recompete. You can't have it buried somewhere else.
Right. And the fourth segment?
The fourth is defense. This is the pure play kinetic stuff, the weapons, the platforms, the hypersonics we just talked about that they're building the factories for. It's the hardware business.
CEO Tom Bell seems very focused on this. On the call, he kept using buzzwords like velocity and strategy execution mode. What's the subtext there?
I think he's trying to change the culture. You have to remember, Leidos was formed through a series of big mergers. The original SAI Fisplit, the massive Lockheed Martin IT merger. It can be a bit of a bureaucratic, slow-moving ship. Bell is clearly trying to make them faster, more agile, more aggressive.
And he's aligning the structure to the money.
Exactly. He explicitly said this reorganization aligns the company with administration priorities. And he specifically mentioned Homeland Security and winning the great power competition. He is reading the tea leaves coming out of Washington and literally redrawing his org chart to match where the federal money is going to flow for the next decade.
Form follows function, as the architects say. All right, let's get to the part that really matters for the analysts, the guidance. This is what they plug into their spreadsheets to determine their price targets. FY 2026. What are they telling us to expect?
For the top line, revenue guidance is $17.5 billion to $17.9 billion.
And what does that represent in terms of growth?
The midpoint represents growth of up to 4%.
That feels very modest. Underwhelming, even.
It is underwhelming,
Right.
especially when you consider that inflation is still running at 2 or 3%. The real growth is pretty flat, but here's the catch. And this is absolutely critical. Management explicitly stated on the call that this growth is backloaded.
Backloaded. Probably the two scariest words you can hear on an earnings call.
They usually are. They are telling the market very clearly that the first half of 2026 will be slow. It might even be flat or slightly down year over year. All of the acceleration, all of that 4% growth is supposed to happen in the second half of the year in H2.
Why? Is this just hope? Or is there a concrete plan behind that timing?
It's a bit of a plan based on timing. They're waiting for some of those big task orders to ramp up. They're waiting for the Entrust acquisition to close and start contributing revenue. They're waiting for some of those new manufacturing lines to begin low-rate production.
But from an investor's perspective, backloaded just screams execution risk. It means if anything goes wrong in June or July, a budget delay, an integration problem with Entrust, you miss the number for the entire year.
100%. It requires a leap of faith from investors. And right now, after that revenue miss, the market is very, very short on faith.
Okay, what about the bottom line? What's the EPS guidance?
They guided to a range of $12.05 to $12.45 per share. The midpoint of that range is $12.25.
And how does that compare to what the street was modeling before the call?
The prior consensus on the street was $12.32. So the guide is slightly below consensus. It's not a disaster, but it is technically a guide down, which never helps sentiment.
And margins, are they holding the line there?
No, they're guiding to a margin in the mid 13% range. And that's a step down from the 14.1% they just achieved in 2025.
Ouch. So after a year of great margin expansion, they're guiding to margin compression.
They would call it normalizing. They say that 2025 had some one-time benefits that won't repeat. And as we discussed, the health segment is seeing lower margins due to competition. So the overall business mix is shifting against them slightly for this coming year.
Is there any chance they're just sandbagging here? Are they just setting the bar incredibly low so they can easily step over it throughout the year?
I think there is a very high probability of that. You have to look at what is not included in this guidance. First, the guidance does not include any of the revenue or earnings from the Entrust acquisition yet. They said they will update the full year guide after that deal closes in Q2.
Okay, so that's a potential source of an upward revision later.
A big one.
Yeah.
And second, the guidance does not assume that they win any major task orders from some of these massive multi-billion-dollar IDIQ contracts they've been awarded.
IDIQ.
Indefinite delivery, indefinite quantity. It means they've been approved to compete for work under a big contract vehicle, but they don't have the specific task orders signed yet. They mentioned the Golden Dome program and a big defense microelectronics IDIQ.
So what's Golden Dome?
It's a major missile defense program, huge potential money. But since they don't have the specific task orders signed and funded yet, they are conservatively not putting any of that revenue in the forecast.
Well, this is a de-risked guide.
It is a very, very conservative guide. It leaves a ton of room for them to beat estimates later in the year, but it offers absolutely zero excitement for Q1 or Q2. It's a wait-and-see guide, and the market doesn't like to wait.
Let's zoom out a bit and look at the broader investor context.
Mm-hmm.
How does Leidos, the stock, compare to its peers in the defense sector right now?
It is lagging severely. Over the last 3 months, Leidos stock is down about 13%. Now, compare that to the broader defense and aerospace sector. You can use the ITA ETF as a proxy. That ETF was up 14.5% in the same period.
That is a massive performance divergence. We're talking about almost a 30-point spread in relative performance.
It's huge. The defense tape, which is just the general sentiment for defense stocks, is very strong. Geopolitical tension is high. Defense budgets are rising globally. But Leidos is being left behind. It's being treated as a broken stock.
So why the disconnect? Why is the rest of the sector rallying while Leidos is selling off?
Because the market perception is that Leidos is a services company, while the money right now is chasing hardware and technology companies. Services are seen as lower margin, slower growth, more vulnerable to things like government shutdowns. Hardware like building missiles and ships is seen as high growth and high priority.
But wait a minute, Leidos is trying to pivot to hardware. That's the entire point of tripling their CapEx and building factories for hypersonics.
And that is the fundamental disconnect. That's the whole story right there. Management sees a company that is actively transforming itself into a technology and hardware powerhouse. They're talking about hypersonics, grid engineering, drone ships. But the market still sees a legacy government services company with shrinking revenue and a big hole to fill from lost health volumes.
So the market hasn't bought into the transformation story yet.
Not at all. They see the cost of the pivot, the lower free cash flow, the new debt, the integration risk, but they don't trust the payout on the other side yet.
Okay, so if I'm a listener, and maybe I own this stock or I'm thinking about it, what is the one key signal I should watch? What's the leading indicator that will tell me if this turn is actually happening?
Without a doubt, you need to watch the book-to-bill ratio. In Q3, it was 1.3x, and in Q4, it was 1.3x again.
Explain that metric again for the folks in the back. Why is that so important?
Book-to-bill measures demand. It's very simple. For every $1 of revenue they billed and recognized in the quarter, they booked $1.30 of new future orders. It is the single best leading indicator for a company like this.
Because if you are booking more work than you are billing,
Then eventually, revenue must grow. It's just mathematical gravity. It means the backlog of future work is growing, not shrinking. The problem is the lag time between booking the order and actually starting the work and billing for it.
so the tank isn't empty. It's just taking a while for the fuel to get to the engine.
The tank is far from empty. The tank is filling up. The 8% sell-off is pure frustration with the delay. But that 1.3x book-to-bill is the green shoot. It's the data point that suggests the growth really is coming.
And there was some specific award slippage they mentioned, right?
Yes, this is a huge potential catalyst. They said $7 billion with a being expected award slipped from Q4 into Q1 because of those shutdown-related delays. If those $7 billion in awards hit the press releases over the next few weeks, sentiment could reverse on a dime.
All right. We have dissected the past. We have analyzed the present. Now it is time for the part of the show when we look at the future through a very specific and, let's be honest, a somewhat dangerous lens.
Oh boy, I know where this is going.
It is time for our This Is Not Financial Advice segment.
Let me get the disclaimer out of the way first. We are just two voices on a stream. We are not investment advisors. Do not trade based on anything you hear. Do your own diligence. Consult a professional. This is purely for entertainment and for intellectual stimulation.
Exactly. But let's stimulate some intellect. I have a trade idea. It's a bit wild, I'll admit, but I think it fits perfectly with the data we just unpacked. I am calling this trade short the spark, long the shovel.
Short the spark, long the shovel. Okay, I'm intrigued. Pitch me.
Here is the setup. The biggest macro story that isn't about war is that AI is eating the world's power grid. We all know this. Data centers need a shocking amount of electricity. So hedge funds have been piling into utility stocks, the spark. The XLU, the utility ETF, has been rallying because the consensus trade is that utilities are the big AI play.
Right, they sell the power, so they must be the winners. It's a simple, logical trade.
It's too simple. And here's the problem with it. Utilities are regulated. They are slow-moving monopolies. They have caps on their return on equity. If a tech company needs a new substation for a data center, the utility might take 5 years just to get it permitted and built. They are capital intensive and they're very sensitive to interest rates.
They're elephants trying to dance.
Exactly. But Leidos, with this Entrust acquisition, is the unregulated fixer. They are the shovel. They become the premier engineering firm for upgrading and hardening the grid. When a data center needs a gigawatt connection now, they don't call the utility and wait 5 years. They call a firm like Entrust, now part of Leidos, to engineer the solution immediately.
So Leidos gets paid cash up front for the engineering and integration work. They don't have a regulatory cap on their profit margin for that service. They capture the urgency of the crisis in a way the utility can't.
Precisely. So the trade is this. You short the utility ETF, XLU. You're betting against the speed of their ability to actually monetize this AI boom. And at the same time, you go long Leidos, LDOS, aggressively. You're playing the spread. You're betting on the infrastructure build out, not the slow-moving utility asset base.
That is a fascinating way to play it. A pairs trade on the AI power theme.
And here's the kicker. The way you express the long side, you don't just buy the stock. You layer in a long call option on Leidos with an expiration date out in 2027.
Oh, okay. So why the 2027 call option specifically?
Because the CEO gave us the timeline. He explicitly stated on the call that the Entrust deal becomes accretive to earnings in 2027. The new manufacturing plants for hypersonics and missile defense come online and start generating revenue in 2027. The back-loaded growth story from their guidance fully realizes in 2027.
So you use the option to completely skip the choppy, messy transition year of 2026.
You skip it entirely. You use leverage to make a specific bet on the breakout year that management has essentially circled on the calendar for us. It's a leap strategy. You're buying the transformation, not the transition.
It's a speculative correlation play on infrastructure failure. You're betting that the grid is going to break and Leidos is going to get paid handsomely to fix it.
It's definitely wild, but it's logically consistent with the company's own strategy.
Just remember, options can and often do expire worthless. The risk is not trivial.
Which is why, one more time, this is not financial advice.
Indeed.
All right, let's wrap this up. Let's put a bow on it for the listeners. What's the final takeaway?
Leidos delivered a classic profitability beat that was wrapped inside a revenue miss. The market panicked on the revenue miss and sold the stock down 8%. But the underlying engine, the cash flow, is stronger than ever, converting at an incredible 127%.
And 2026 is clearly, unambiguously, a transition year. They are spending heavy money, tripling their CapEx to build new factories. They are spending billions to integrate the Entrust acquisition, and they are asking investors to wait for a back half growth ramp.
The sell-off reflects that impatience, but the key number, that book-to-bill ratio of 1.3x, is the signal from the noise. It strongly suggests the growth is just delayed, not dead.
So the key things to watch are the Entrust close date in Q2, and more importantly, watch for those $7 billion in slipped awards to hit the tape.
If you see those big press releases start dropping in the next couple of months, this whole negative narrative could turn around very, very quickly.
Thanks for listening to Talk Tickers. We read the transcript so you don't have to.
Good luck out there in the markets.